Okay, one thing I'm going to do is, so there were two requests. I think a lot of people are overlapping from my last workshop, which was on LLMs. So I sent a notebook to to the collab. Everyone can visit it and download it. It's one of my previous messages up here. And for this workshop, I'm going to send another one right now. This is the notebook we're going to follow along for this workshop. So I'll just start the screen share now. Okay, perfect. I think everyone can see the screen. Cool. Okay, I mean, Murat already gave a pretty good introduction on my end. I guess just to summarize, yeah, I've been a data scientist at C3 AI for a couple of years now, working a lot on machine learning for enterprises, different use cases, and these days a lot on LLMs, actually developing LLMs for our own custom use cases, for our own specific domain. So that involves actually pre-training some base LLM, doing additional fine-tuning, and then having that work for example, like your company's specific data. Now, on top of that, and let me know if people are actually able to access this collab. I mean, there's about 108 of us here.
Yes, I
Thank
can
you.
access it. I believe
We
everyone
supposed the other
can.
collab link, could not find. Um, Try to scroll up because it's going to be hard to multitask. But in the end, in the end, I'll dump the links again. Okay, but just to continue, I also really just like investing. I think I spend too much of my free time just following investment news, following some thought leaders on the stock market. And of course, there's a lot of overlap there with machine learning. There's a lot of content that we could cover. And in the full bootcamp, which I think is 12 weeks, but I'll double check, might be 10, might be 12. We'd go into a lot more of the fundamentals. At least for this workshop, I always like to create a workshop that you can take something home with and run it yourself, try it yourself, learn some interesting concepts. But there's only so much we can cover in 1 hour. So I'll try my best and hopefully 100 people potentially accessing this doesn't blow it up, but let's see. Let's have some fun. So again, I want to share some AI techniques that we can maybe apply to stock market data, generate insights. Honestly, even just data analysis is probably 80% of the battle, in my opinion, for being a good investor and turning data to dollars. I think right now there's also a lot of excitement in the stock market because we went from a market in 2022, not too long ago, that was pretty bearish, pretty red, to especially in the last 6 months, very, very bullish. A lot of stocks are making money, some that I like to review, and they're all up a lot. And I'm curious in the chat, I mean, how many people actively invest, maybe outside of index funds, but index funds are still like a great idea. I'm just curious how many people invest in companies. Uh, but anyway, in the last 6 months, I mean, a lot of companies that are popular among retail investors have just surged. Like Tesla, SoFi, Palantir up 230% in 6 months. FANGs as well, right? Like Google, Facebook, uh, Nvidia, of course. So seems like there's definitely a lot of interest here. Let me give an intro then on the workshop and we'll kind of walk through all this. So I want to walk through more of the machine learning side of things, which is just like one part of the puzzle. I mean, at the end of the day, I think a lot of people have the question, can you predict future stock prices or trends based on historical data, right? Uh, and that can help guide investment decisions. There's now some people do short-term trading or even maybe high frequency trading, trading at the second level or few second or minute level. But I do just want to iterate, just like flash the fundamentals that, in the long run, stocks follow their earnings, right? At the end of the day, and this is some fundamentals that maybe if you're not aware of or you're somewhat new to, we'll kind of hammer down on. But stocks, the stock market is an expectation machine. And the expectation at the end of the day, when you boil it all down, is earnings, right? How much profit is a company going to make? And you invest in a company at the end of the day, now for many reasons, but let's say you couldn't ever sell the company. If you actually bought it and you wanted to hold it, you would invest in it because you think it's going to generate more profit for you, more money for you than you're buying it for. And that's all the game boils down to. But, on the day level, on the week level, there's so much noise, expectations vary, sentiments vary, world news vary. So you get these huge variations. But historically, blue line is, let's say, S&P 500 earnings. Black line is the stock price. And I hope you see the stock price here leads the earnings. So in all recessions, let's say in 2008, the stock prices started to go down before the earnings went down because people anticipated these things. They see businesses are closing, people are spending less. So they anticipated 3, 6, 12 months out. Similarly, for COVID, you'll see the same. And then you'll see now stock prices, or at least before, stock prices going up, people anticipate earnings going back up. Just trying to hammer down those fundamentals. I always like this phrase: in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Voting because it's a market of buyers and sellers. You really don't know what's going to cause buying and selling on a particular day. But you do know in the long run, it's weighing the quality of the company, how much money they're making. So maybe for us, we can use historical data to help forecast what a stock might do in the short term, right? But in the long run, and what I'll show in the course more, I'm not going to focus on it too much in this notebook. We need a different kind of modeling approach, one that forecasts how a company's earnings, their profits, will grow. And I am seeing, okay, just to make sure everyone can follow along, let me make sure I just copy this and put it in the chat notebook. Okay, we should be good now. Right, so let's say for NVIDIA, what caused their price movement? Really, they started making a lot more money. It's as simple as that. In Q1 of 2024, or even in 2023 as well, their earnings are a few $1 billion per quarter. And now that's shot up to $19 billion a quarter, right? You get over a 10x in earnings, you're going to see it over a 10x in your stock price. Can you predict that with a model in the short term? Maybe. But generally, I find it comes down to the quality of your assumptions and your research when you want to play the long game. But okay, I wanted to, preface that and make sure we're all aware of fundamentals. But for now, let's look at how we can think about forecasting in the short term. And I think Murat was giving a lot of these tools that are super helpful. I'm going to cover some of them, like Yahoo Finance. We might want to participate in short/medium term trading and potentially find patterns and algorithms that can help us in the market. At the very least, like getting the data together and doing this analysis is useful to have a baseline for predicting price and what factors maybe historically cause a stock price to move. So I want to review common forecasting methods, introduce some tools and techniques that we'll use for stock market analysis, different statistical modeling, other AI neural network-based techniques. Now, the notebook is probably more, there's code here for sure. So I'm not sure if some people have a very strong coding background, medium, less. I think it's friendly for all levels. If you're proficient, this is a good template to jump off from. Add more data, add your own modeling techniques, and so on. If you're more beginner, maybe this can help you, get introduced into the topic, and then start building your proficiency from there. So again, for anyone asking for the notebook, I did previously send it in the chat. I'm wondering if there's a way to pin it, since I think this will be consistently asked. If there is a way to pin it, that would be very helpful. I'll just take a quick second to check here. Maybe what someone can do is just create a question in the question answer section. Just create the question, where is the notebook? And then I can paste it in. So again, there should be like a Q&A section. And I think that stays open for everybody. Cool. So this is not perfect. Where's the notebook? And somebody has already. Okay, we're probably good with a few of these. And I'll just start sending some answers. Perfect. Cool. Okay, let's jump into it. Live notebook. I mean, the version I shared with you guys is a view only, just so we don't have 100 people running code on the same notebook, which would be very messy. But you can download it, right? Save a copy however you want, download as a Python notebook, and then open it on your end, and then you'll be able to run it. There's a section here you'll see where I have an API key. I haven't left mine in. I have it in memory though, so this will work. But let's first start with loading data. Okay, that's like the core of all of this. We're going to use Yahoo Finance. Like Murat was saying, honestly, use ChatGPT, use other AI tools for this because a lot of it is boilerplate. Once you have the boilerplate, then you can start doing the fun stuff. But in the beginning, you just want to grab data. So what I'm doing is I want to look at Palantir, which has been historically one of my favorite stocks. Just to think a really high quality company, and it's done like phenomenally this year. Let's see. Yeah, it's huge surge this year. Okay, can we forecast it? Let's see. We can load in the data and maybe take a look at it, right? I started from 2021, January 1st. And by default, we can get a few different info like columns from Yahoo Finance. The close price, the open price that day, the high, the low, and the volume. Again, this is working on a day level. And the first thing I would say is if you want to go more advanced, you might need more granular timestamps. Like at the lowest, maybe it could be at the second level. Typically, as you need this more and more granular data, it becomes less free and more expensive. And you have to actually start paying API providers to have access to this data. For now, daily is fine. It's free. It's easy to use. And we get a data frame. I'll just open this below here with this historical information, right? From beginning of January of 2021 until now, where we've gone from $23 to 76 now. So that's information about the stock itself. And we can add a lot more to that. But generally, if you were going to try and predict what a stock is going to do, it's probably a good idea to know what's going on in the general macro economy. Like, is the economy good? Is GDP growing? Is inflation okay? If you were following this in 2021, 2022, 2023, you know that inflation was probably the biggest driver of a lot of stock market moves. The expectation of inflation first going up, causing stocks to go down. And then now that inflation has mostly settled, stocks going up as a result. We can actually, and there's many different API providers. I've set up the St. Louis Federal Reserve. So they have an API, just some utility functions here. But you can sign up for a free API key, probably takes like a few minutes. Specify some indicators you want: GDP, unemployment rate, CPI, federal funds rate. And let's go. We can just get this for our API key of start date and an end date and get access to all of this data. I'm going to spend more time analyzing this in the next section. Just know that we have it. The next thing you might want to do is combine this. So we can just use pandas to combine this on the date field, and then get all of this in one nice data frame where we have, for that given day, what was the information here. One thing just to keep in mind, and this alone, you could spend hours on. Data is usually messy. You're going to have missing data, random values. Typically, you can spend a lot of time cleaning this. For now, just know that the demonstration I have, okay, has like one missing data. I'm just going to drop it and continue on from there. It's one day of data. It's okay. I don't mind dropping it. Okay, this is the fun part. Let's visualize what the stock looks like. This is Palantir. Okay, one thing you might want to do, and again, the code here is very straightforward. You can put this in a function and make it more modular, but what has the stock price done in this time frame? We see that in blue. We're in the beginning of 2021. It was actually in the 20s. Quickly rocketed up to around 40, and then started a slow descent, as many stocks did, until around beginning of 2023. It actually got to around like $6. Then march back up to the current prices today, basically. You also see, I've also plotted secondarily the volume, right, as these red bars. Typically, what you'll see is on days with high price action, let's say this day right here, where seemingly in like one day, the stock has shot up quite a lot. You also have a ton of volume that day. Volume being, and again, if you're unfamiliar with these concepts, that's fine. We would cover them in the course. We'd cover all the fundamentals of these terms, earnings, EPS, volume, whatever it might be. But it just means how many shares were traded. Basically, if you imagine a market with people buying and selling, I mean, how many people are in that market? How many buy and sells have there been? When there's high volume, that means there's a lot of interest. Typically, something happened to cause unusually high volume compared to the normal. On this day, 40 million shares, 400 million shares traded, which is a lot. Another thing you could look at is those macroeconomic indicators that we talked about, right? Honestly, sometimes it's hard to find this information. If you can be self-sufficient and be able to pull this information yourself and play with it yourself, analyze it yourself, that's 80% of the battle. A lot of the time, it's just trying to find good websites that do this for you. Forget the websites, we can do it ourselves. So GDP, right? What has GDP been in the United States in this time period? We can plot it here. If we wanted to do a growth rate as a percentage, we could get that too. Unemployment rate, right? From the start of COVID, quite high to the lows, now seemingly finding some balance around 4-ish. And then our favorite CPI, right? CPI on its own might be hard to interpret, but really the slope of this is inflation rate. This is a relatively high slope. Like around this time, inflation was 6, 7, 8% as measured by CPI, where the target is typically 2%. So that was a no-no. And actually, if you wanted to, you could plot CPI on top of the federal funds rate. Federal funds rate is the interest rate for the banks, right? Interest rate is how much does it cost to borrow money? That's the simplest definition. Typically, when it's cheap to borrow money, then there's a ton of investment. Think about it. I mean, if it doesn't cost you anything to borrow money, maybe you'll go buy that house because mortgage rates are low. Maybe you'll go buy that car. You feel better about just purchasing in general. And everyone's happy to lend. Companies will also invest because typically companies go into debt. They borrow money, maybe to build a factory, invest in their equipment, invest in their employees, hire more, whatever it might be. Now, when it goes back up, and now in this time in COVID, just to give some context here, because it's important we know when we're actually trying to make money from stocks and do these type of predictions, we need to understand what was actually happening and what is happening in the world, in the economy. The federal funds rate, interest rates were zero because it was COVID. There was a huge lockdown. So the Federal Reserve, the central bank, is like, oh, we're going to drop interest rates to zero to make sure the economy stays afloat. People feel okay spending despite a lot of these things shutting down. What happened is now there's money everywhere. You get inflation because there's more money supply. And on top of this, the Federal Reserve is printing a lot of money, but we don't need to get into that. You get inflation. Inflation is bad. Inflation destroys wealth. So then the Federal Reserve around this time is like, no, 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 we need to increase the interest rates so things start to cool down. People are less likely to buy or less likely to go into debt, less likely to spend. Economy slows down by definition when you increase the federal funds rate. And they increase it a lot. From 0 to 5 is enormous. And that's basically why, if you look at a lot of these stocks around that time, let's say even Palantir, around this time, and in anticipation for this, they got destroyed. They go from 30 to 6, losing 80%, which is insane. Imagine losing 80% of your investment in a year. It wouldn't feel good, and it didn't feel good for a lot of people. But that's what happens when interest rates shoot up like this and there's real issues in the economy. There's a real threat of a recession and all of this. So again, keep this context in mind. I would go more into this with more time, but I want to walk through the notebook. I just find it super fascinating. Okay, we have this information. Explore at your heart's desire. The next thing we can do is we have all this nice data. We can, we might want to compute more information, more features, as we call them in machine learning, to help build a model or to help just do like analytics and insights. Right? We can call this feature engineering. It involves creating additional variables that just might improve the predictive power. Super useful for extracting insights. I'm just going to show some. You might want to include moving averages, right? This is very common in stock markets. Just do a simple sliding window. Hey, what was the average stock price the last 10 days, 20 days, 50 days? And it kind of gives you an idea of maybe stably a high bias, low variance estimate of what is the price doing. You might want to do volume trends. You can compute other fancy metrics like RSI, relative strength index. Here is an example of manually computing RSI if you want on the stock price. We don't need to go to what it is, but we can compute RSI. We can compute a 1-day lag. If you're familiar with time series forecasting, or honestly anything that involves time and forecasting, lags are important. Lag is just a fancy word of saying what was the price yesterday. So if my task for forecasting is to predict tomorrow's price, something that would be super helpful is yesterday's price. Because typically it probably won't change too much from yesterday's price. So we can compute a simple 1-day lag. We can also compute, again, just for an example, a 50-day moving average and a 200-day moving average. Again, feel free to use AI for these. You will get some gotchas when you do this with AI, which is why it's good to build the fundamentals of actually understanding coding and understanding these libraries, which is something we would do in the 12-week course. But okay, we have these features, and then a whole other concept is, if I show this data frame, we have time. How do you give time to a machine learning model? One approach is to just simply decompose it into year, month, day, and weekday. This is interesting because maybe you'll notice certain weekdays, Monday, Tuesday, or Wednesday, when you do this analysis, typically there's some insight there. There's some trend. Maybe Mondays are really good for your stock, or maybe Fridays are really bad. And you can get that if you have this feature. Anyway, now that we've done all of this feature engineering, we can take a look at our data frame. Again, bunch of information about the stock price, about volume, about GDP, unemployment rate at that time, CPI at that time, federal funds rate, so on and so on. I will say, because I'm seeing people ask how to get an API key, I think some people are posting information on how to do this. What I'll say is this: if you don't have an API key, the notebook, other than this visualization, should still run without an issue. So all you have to do is scroll up here. Just don't run this line, right? Comment this out where we're getting Fred data. Don't run this, and don't run the next cell. What that means is your data frame is not going to have these columns, but it's okay. The rest of the notebook will still run. We can still do a lot of the following tasks. So again, just don't run these. You might have to. You might just have to run a cell like this. Unfortunately, this will be a little bit of a bit of surgery, but essentially that's all you would have to do. Okay, let's continue. And again, it's recorded, so you guys can follow along later. Maybe once you do have an API key. I think it should just be as simple as like Fred get API key. Yeah, just first Google search. First logging in. Yeah, so first you need to create an account. So I'll just drop this into the chat for everybody. Create a Fred account to get the API key. Okay. Excuse me. Sorry about that. Okay, let's continue. We still have a lot to go through. I want to cover a bunch of different forecasting approaches. If you followed with me so far, again, we left off here. We have a data frame with a bunch of different information. This might make sense if you're familiar with machine learning and data science. It might be completely unfamiliar. This is an Excel sheet basically, but in code form. And you have a bunch of different information, which we can give to a model to hopefully help make a good stock price prediction. That's what we're going to do in this next section. Hopefully maybe spend around 15 minutes here. And then I'm happy to leave some time for Q&A. Here's where you kind of get the takeaway of actually having models, machine learning models, to do stock price forecasting at the day level. Before we jump into that, let's cover some setup to do this, right? Again, maybe you're familiar with it, maybe not, but to evaluate model performance, we always need to split our data into at least a training and test subset. Just quick preface on this. If you're going to train a model, and even when you look at the stock price, I can very trivially, just looking at data that has already happened, draw some line that matches this very well and say, oh, great, I have an amazing function because it really closely matches the data points. But that's not fair because, this is your training set. This is, of course, you can trivially just draw a line to fit this as best you can. And when I say you, I also just mean like some machine learning model. What really matters is, can this model generalize to future? How does it do on data it has never seen before? That's why you create a test set, right? And typically for time series models, the test set always needs to represent future data. We are always interested in predicting the future, not the past. And there's data leakage concerns in that as well, but whatever, we don't need to get into that. So we would do something like this. Let's say we just split the data for the 1 year. I'll say I'm going to train on information until September. Let me get a click here. Right, until September backwards. I have some model. Then I need to evaluate how this model does from September until November. It's never seen September till November. It's going to be pure test set. And then how well does the line fit into this new data will determine how I feel about the model's performance. And when I say feel, I mean we'll have an actual metric to measure this. But okay, another quick thing. What is the thing we're predicting? In machine learning, we need a target. We need something we're trying to predict. For this exercise, for this notebook, it's going to be tomorrow's stock price. So again, looking at data, my data frame. This is all information at today's level. Standing on this date, let's say by the end of this day, this is what the close price was, high, open, low, volume, so on. But what I actually want to predict in this example is tomorrow's, let's say, close price. That's what I've decided what I want to predict is. So what I actually need is just mechanically, I'm going to make this my target for this day. So if I'm on January 5th, 2021, my goal is to predict January 6th close price. What I'm doing here is just mechanically creating a new column called close tomorrow to be our label, to be our target. And then I'm also specifying our X columns, which is just actually everything. And then make sure you drop the target, make sure you drop the label. I'm going to use all of this information to try and predict tomorrow's price. And I'm going to say I'm going to use 80%. That's why there's 0.8 here, 80% of all my data available to train the model. And then I'm going to use that final 20% be for the test set. Information the model has not been trained on. Okay, so we can run this. We see what columns we're using. We see our target variable. And for training, we have 789 rows. For test, 198. Just reading a comment here was prediction for abnormally high gain after the Q3 report. Shaquille, I'm not sure I understand the question. But hopefully I can, it comes up or it gets addressed in the next part of this notebook. Okay, let's plot what we've done here. This is the price as we've seen. Green is what I'm going to use to train. Orange is what I'm going to use to test. Right, this is where I've split the data. In reality, there's more sophisticated ways to do this. If you are more of an expert in data science and machine learning, you will know that doing some type of forward march cross-validation approach is good for time series data. I won't get into it now. It's fine. We'll keep it this way and just have a simple evaluation. Another thing to do, while we're on the topic of machine learning, it's very common when you start out to want to build like the most complex model in the world, use 20,000 layer like neural network and all these fancy tools. It's always a good idea to have and create a really simple baseline for whatever model you build before you start going too complex and too deep. One approach is just taking a moving average. There's other simple baselines you can create. But you really want to help establish a baseline for more advanced, more time-consuming things, because if you find out after 2 hours that your advanced thing can't even beat the benchmark, or even worse, if you find out after 200 hours of work that it doesn't even beat a simple baseline, it's wasted time. So let's see let's say a 50-day moving average, how that performs as a model. Okay, so I'm plotting here. Do I not have close 50 MA? Did I miss I might have missed a column to run. I think up here. I thought I ran this. Ah, okay. I was missing that the whole time. Okay, I'm going to rerun, make sure our data is up to date. Perfect. Okay. So the green line is the 50-day moving average. As you see, like it follows it, but is this good? Okay, again, a whole other class, like what is good performance? But this is what the 50-day moving average would tell us. How do we evaluate this model, right? In general, how do you evaluate the performance of predicting a stock price? One way is, we can treat this as a regression problem in machine learning. We know what the target should be. We have a model that predicts its best prediction, and there's going to be some error there, right? The difference between what the truth is, what the actual value is, and what our model predicted. There's many different metrics that are useful here. I'll just say for stock prices, we typically care about relative error. Saying you missed by $1 on average isn't meaningful. If the stock price is $2 and you missed by $1, that's a lot. If the stock price is $1,000 and you missed by $1, yeah, that's actually not so bad. So we might want to use something that's percent based, which we have. It's called MAPE, mean absolute percent error, to evaluate how good are our models. I have just created this function to make it, for educational purposes, really clear what MAPE does. But you could also just import this metric from sklearn, from like existing libraries. Let's compute our MAPE. Okay, again, all it is the absolute value of, well, essentially the difference between your prediction and the true value relative to the true value. And it's a percentage. Okay, so on average, we're 13.88% wrong on our test set, right? That's what we're doing here. It's purely test set. So on average here, yeah, 13.88% wrong. But, if you're looking here, clearly when the stock price is like rocketing up in the last few days, I think this is the Q3 question, moving average can't catch up. This is such a huge move that the previous 50 days haven't even factored it in. So I suspect a lot of our errors coming here. But that's the nature of stocks. Sometimes they have explosive days. Cool. Let's say we've done this though. Oh, great. 13.88% MAPE is our benchmark, our baseline for the test set. Okay, that's not machine learning, although maybe you could argue it is, but not really. The reason that's a simple baseline is think about it from like an information perspective. What information am I using for this model? The only information I'm using to predict tomorrow's price is yesterday's price, and yesterday, multiple days back. So I'm only using previous price to predict future price. That's just one dimension of information. I have a lot more information though, like unemployment rate, the day of the week, CPI, blah, 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 blah. And I could add so much more. If I have this information, shouldn't I be able to make better predictions? I mean, the answer generally is yeah, you should be able to. And that's what we use machine learning models for, and they're able to, fancily figure out the patterns in all this information. Here, I'm just going to quickly demonstrate, and I see we're kind of getting close on time, a random forest model. I'm not going to be able to go into the details here, but I'm just training a very naive model on the test set or on the training set. And if you're not familiar with machine learning, yes, like in the most simple form, this is what it takes to train a machine learning model, 2 lines of code. Now, this is the happy path. The complexity comes in when you stray away from the happy path. But okay, we have some predictions. We've trained the model. How does it do? This is what I'm plotting here. As you'll see, so our MAPE, mean absolute percent error, is, why is it highlighting? Pretty good. Like it really follows this line for the training set. But okay, seems to kind of do this for the test set, but then completely fails to, capture what's happening at the end here, this latest explosive stock movement. And I'm sure most of the error is actually happening here. Again, we can go into details. Typically, machine learning models will overfit on the training set and underperform on the test set, which is what we're seeing here, like a 9x difference. But you know what? It's still better than our baseline. So let's just move forward. You might be wondering, like, what causes the model to predict these prices? In a random forest model, you can get an idea of the most important features, and you'll actually, you can plot this out. Funny enough, I've brought up all this information about interesting features. What this model is telling me is it really does not care at all about almost all of our features. It mostly only cares about 3 to 5 features, being, the close price, the high, the low, the open, the 1-day lag, maybe a little bit of these guys, but very simple model, basically just using yesterday's price to predict tomorrow's price. Simple, naive, we can make this more complex in many different ways. This could be a whole 2-hour workshop easily. But I want to get into the final kind of accumulation here. If you think about it, and if you're familiar with machine learning models, what we're using to train this model, and I'll just go here, xtrain. The model just sees one row at a time, one snapshot of 1 day to predict tomorrow's price. But this is like a sequence. Typically, wouldn't you want to see, multiple days back and find a way to incorporate that? Generally, that would make better predictions. Many ways to approach this. The last thing I'm going to share is maybe more traditional forecasting models, such as Profit, which is actually made by Facebook/Meta. It's a tool that actually decomposes a time series into multiple components, right? Because you can think about it, under a time series, there's some underlying trend, maybe a monthly trend, right? Because our world works in cycles, monthly, yearly, weekly. There might be other trends and cycles that it's able to pick up. And we can kind of distill and parse out all of these components from the time series using a model like Profit. There's a lot of code here. I'm not going to walk through it. We're short on time. But what we're doing is similar approach. We're actually training this type of forecasting model in a similar way, creating a train and test set. We actually see, but this shouldn't be here. I'm going to remove this. Now that I've trained the model, again, just boilerplate. This is just what Profit requires. We don't need to spend much time here. I'm just saying I want to predict now the future for some period of days from the model I've trained. I'm just simply going to do .predict. Okay, a lot of potentially voodoo magic again, if you're less familiar. If you are familiar, and this is more common, and there's more things we can do than just this. But okay, we've trained the model. Interesting. What does this look like? Some profit forecaster. I've abstracted away a lot of what's going on, but let's summarize it. Okay. Before we look at the plots, I'm going to look at my model's predictions based on MAPE. And actually, it's pretty good. If you see, this is a model that has learned to generalize because its train and test performance are similar, both 3%. If you go back to the random forest, this is an overfit model because it does great on data that it was optimized to see, and it does much worse on any new data, which we don't want. We want it to do well on new data because that's all we care about. Thankfully, this profit model seems to have addressed this for us. On average, it's only wrong by 3%. That's not too bad. And there's a lot of built-in tools for interactive plotting of this forecast. I could look at a 1 year, I could look at a 6 month. There's also, if you see a concept of uncertainty in these predictions that come native to sorry, I'm losing my words here, the profit model. This is forecast is kind of what's storing all the predictions. If you see it's just a data frame, view the generated predictions. It's just a data frame that has a lot more columns now than the test set. And it's actually giving you what the trend is, a lower bound, an upper bound on a prediction, and a lot more information. Oh, and you can actually drag and drop this if you want, or drag this. Look at different parts of the forecast. Okay, well, hopefully this is interesting. Let's look at just final summary here. We're approaching the 1 hour mark. Again, this might feel like a bit of a fire hose. That's okay. I'd rather a fire hose than it'd be too boring. I think there's a lot of interesting stuff here for anyone at any level to take and try on their own and hopefully feel more interested to learn more. We have our training set, which is the blue. Again, this is what we've used to develop the model. Yellow, yeah, our model seems to follow it pretty well. And the great thing is it actually seems to follow the test set pretty well too. And it actually follows, it's able to pick up on, hey, the price shot up, I should adjust my predictions as a result of this, which the random forest clearly failed on. If you'll see, and I mean, it's going to be a bit hard to see this, the day of that big shooting up, fundamentally, this is kind of my opinion, but there's no way to predict out of nowhere that the stock price will go up 10, 20% in a day. But the next day, now that the model has seen that, it's going to probably adjust its predictions to factor in this new volatility and this newfound huge price jump. That's at least what a smart model should do. And we kind of see that here. And see, this seems to be a climax run. Can the model predict when the reversal comes? Maybe. I mean, I don't know if you can predict when it'll come, but this is really just scratching the surface of what the pros do. They use, and you can use so much more information. For example, a lot of people use technical indicators to find out resistance levels in stocks and different patterns that can emerge. These can help you make forecasts. I haven't added that in, but if you wanted to add technicals as part of your prediction, you totally could. But we see, cool, this is not too bad of a model. And by the way, this can just be useful for understanding descriptive analytics about, in this case, Palantir stock. This is just the overall trend, right? Very simple trend of the stock price's performance. And that's basically what we see. We see a downward trend until about, mid 2022, really until 2023, and then just a non-stop upward trend from that point up onwards. Very, very clear. And in a bull market, this just extends for a while. Another cool thing is you can get an idea of the day of the week. Typically, how does this impact the stock price? Now, ideally, I would just remove these completely from the data set. I mean, there is no Sunday and Saturday prediction, but you can see that, if I zoom in here, it seems like Friday, the stock price does a lot worse than any of the other days. So, maybe just from this simple piece of information, maybe I can find a model to do some arbitrage here. It seems to do, on average, more poorly on Fridays and better on Mondays. All right, maybe I can find an opportunity here to squeeze out a little bit of alpha. Yearly as well. We only have a few years of data, so it's hard to read too much into this. But again, there might be months that perform better than others. Palantir has only been public for like 5 years, so there's only 5 years of data max. If you wanted to do this on the entire S&P 500 or a company that's been around longer, you might be able to pull out more meaningful yearly trends. But what is this saying? Hey, November's typically been pretty good for this stock, and May has typically been pretty bad. Extra. And one thing, someone just asked a question, and it's coming down here. Can you see the most important features for the profit model? So there is a way to pull out the importance of regressors. More so how much it's contributing. I didn't have a chance to add this to the notebook so far, but you can at least see of all the different features, which we're calling in profit term regressors, of all the ones we've added, okay, can we figure out how it's contributing to the stock price? So as you can see, the close price is a huge part of it. And close is basically today's close, where the target is to predict tomorrow, which makes sense. I mean, probably tomorrow's price is really similar to today's. But then I can use some extra information to help this, right? What was the impact of the open price? I'll skip down here, of volume, right? Of GDP, which we're seeing is quite minimal, but we're seeing the contribution here. And sometimes you can ask, like, does this make sense? Like, is this a sensical insight? What this is saying is actually as time goes on, GDP is having a smaller, although very smaller impact on the model. Or it's actually, sorry, as time goes on, GDP is causing a reduction in the stock price prediction. Very marginal, but that's the trend it's kind of pulled out. The thing is here is, and again, if you're more familiar with machine learning, if you have very correlated features, which GDP, CPI, interest rates, these things are very correlated. Because of that, the model will sometimes make seemingly nonsensical inferences about these features. This happens all the time in science, by the way. If you have very correlated features, you can end up getting really like seemingly wonky linear relationships. All that to say, there's a lot of details here. I could cover them in more time, but just be careful with highly correlated features. Impact of unemployment rate, CPI, and all these features we have. We really just see how they're contributing. And just so I make this very clear, what profit does is it breaks down all your features into a linear decomposition and then just adds them all up. So like by definition, your prediction for, let's say, 2024 July 1st is the sum of all of these values across all of these features for that day. And again, their level of contribution. I could sort this by that. That would probably be helpful, but year clearly is helping. I mean, that makes sense. As the year goes on, it's seemingly doing well for the stock. And okay, so really that's the end of of the workshop. I think I went through a lot of content. Hopefully it was interesting. Hopefully it gets, again, everyone kind of excited to try this out, go more into investing, learn a lot more since there's a lot more to learn. And then hopefully, again, if I see you, if I see people here again in another workshop or another class, I would want to cover this side of stock price prediction, which is really developing models to forecast earnings. What do we do to understand a company's current value from like a first principles point of view? A discounted cash flow is a common approach to that. And how can we kind of feed in our assumptions and how a company is going to do and model that out into the future to see, hey, if the company is, I think, going to make this much profit over the future, how much is it worth today? That's more like fundamental analysis. But again, for another time, maybe one final lesson is, generally time in the market beats timing the market. If you're going to hold for the long term, that would be useful. But yeah, thanks everyone for attending. I mean, this was a ton of people. Appreciate it. This was fun.
Thank you, Sammy, for the presentation workshop. Again, as Sammy mentioned, we're gonna have more of this in Sammy's mini bootcamp starting in mid-January. You're welcome to go and register. We have an actual early bird. And yeah, hope to see you in a mini bootcamp that covers more extensively. Thank you.
Awesome. Okay. Thanks everyone.
Thank you.